There was this girl Supriti. Now she deposited rupees 500 for 8 months in a recurring deposit scheme. The rate of simple interest, that was 8% per annum. Now Supriti wants to calculate the interest that she will earn in 8 months. Can we help her out? What should we do first? Firstly, we find the equivalent principal for 1 month. Why only 1 month? Because the sum of rupees 100 deposited in a bank for 6 months will earn the same interest as rupees 600. That is rupees 100 into 6. That is deposited in a bank for 1 month. Right? So as Supriti deposits the amount for 8 months, therefore the amount deposited by her in the first month will earn the interest for 8 months. The amount deposited in the second month, that will earn the interest for 7 months and so on. So let's start. She deposits rupees 500 in the first month. Now this amount will earn interest for 8 months. So this means that rupees 500 for 8 months, this is nothing but rupees 500 into 8 for 1 month, right? Now she deposits rupees 500 the second month as well. So this amount will earn an interest for, yes, 7 months. Now rupees 500 for 7 months is nothing but rupees 500 into 7 for 1 month. Like this, I can calculate all the remaining equivalent principals. So I do it. So what is the total equivalent principal for 1 month? When you add all these, you can also write it as rupees 500 into 8 plus 7 plus 6 and so on till 2 plus 1. Now look at this expression. I can also write it as 8 into 8 plus 1 by 2. How did I get this expression? I use the formula for the sum of first n natural numbers, and that is n into n plus 1 by 2, right? Now when you simplify this expression, what you get is 4 into 9. You simplify this expression now, and you get your answer as 18,000. Now we need to apply the formula for simple interest. SI equals P into R into T by 100. The principal, 18,000. Rate, 8% per annum. Time, 8 months. So I'll write the time as 8 by 12. I've tried to convert this in 2 years. Now I solve this expression and I get 960 as my answer. So the maturity value of this amount for Supriti, that would be rupees 500 into 8, the principal, plus 960, the interest. You simplify this and you finally get rupees 4,960. So the interest that Supriti earns in 8 months is rupees 960 and the maturity value, that is 4,960.
If you borrow money from a bank, you know these guys charge an interest. And more often than not, they charge compound interest. What does that mean? Let's look at this example. I borrow 16,000 rupees from the bank. And bank says, I'll charge a rate of 5% per annum for 2 years. And hello, they're talking about compound interest. So how much of interest do I need to pay them after 2 years? Initially, the principal is 16,000. Rate is 5% per annum. So what happens in the first year? I hope you know your simple interest formula. So for the first year, let's calculate the simple interest. 16,000 into 5 by 100 into 1 year, you get 800 rupees. So after the first year, the interest is 800 rupees. Now in the case of compound interest, what happens is this interest gets added to the principal. So in this case, 800 gets added to 16,000 and you get 16,800. And this amount is taken as the principal for the second year. So now we move to the second year. Principal is 16,800. Rate of interest is 5%. So what is the interest for the second year? 16,800 into 5 by 100, which is 840. So what was the total interest that I would have to pay for 2 years? 800 plus 840, which is 1,640. So this is the total interest, the compound interest that I will have to pay the bank. So what is the total amount that I'll have to pay after 2 years? Remember, the principal was 16,000 and the interest 1,640. add the two, and you get 17,640 is the amount I'll have to pay. So I paid an interest of 1,640. You know something? Had it been simple interest instead of compound interest, I would have had to pay lesser. How? What would have been the total interest in that case? Simple interest formula, 16,000 into the rate of interest 5 by 100 into 2 years. That gives you 1,600 rupees. So I would have had to pay only 1,600 and not 1,640, which I paid in the case of compound interest. So I end up paying 40 rupees extra.
Formula on the screen. A equals P into 1 plus R by 100 raised to N. Now what is this formula all about? This formula tells us about the amount after N years when the interest is compounded annually. Okay? A here is the amount, P here is the principal, R here is the interest per annum, and N here is the number of years. So in short, this is the formula to find the compound interest. And let me prove it to you. Now we can prove this formula using the concept of simple interest. For this, first of all, let me draw a table. Now do you see these three columns? This column is for the principal, this column is for interest, and this column is for the amount. And what is amount? Nothing but principal plus interest. Okay? Now look at the three rows. This row is for the first year, this row is for the second year, and this row is for the third year. Let me also assume the principal for the first year to be P. So I write P here. Now what would be the interest for the first year? What is the formula? I equals P into R by 100. So I write P into R by 100 here. Now what would be the amount for the first year? It would be principal plus interest. So P plus PR by 100. I take P out and I get P into 1 plus R by 100. So this tells me about the principal, the interest, and the amount for the first year. Now let's move to the second year. Look at this. Yes, the amount at the end of the first year. This now becomes the principal for the second year. Now what about the interest? I calculate my interest on this principal. So my interest is P into 1 plus R by 100, that was the principal, into R by 100. Lastly, what would be the amount for the second year? For this, I have to add this principal and this interest. So I do that. I now take P into 1 plus R by 100 common. So what I'm left with is this. And now I combine these two terms. So my amount becomes P into 1 plus R by 100 whole square. So do you see any pattern that is forming? Yes. The exponent of 1 plus R by 100 in amount, that keeps on increasing. Similarly for the third year, the amount at the end of the second year would become the new principal. Try and find the interest, add the principal and the interest to find the amount for the third year. You will see that the amount is nothing but P into 1 plus R by 100 whole cube. Okay? So we can also generalize this formula. So this is the pattern that we are getting. Now we can generalize this for n years as well. This means that amount at the end of the nth year, that would be given by P into 1 plus R by 100 raised to n. The same formula that we were talking about in the beginning. So this proves the formula. And what did we use here? Yes, the concept of simple interest.